Yet it's on the 787. Boeing did self-report it to the FAA, which is a positive step. It's a very heavy physical task that the Boeing workforce performs in Charleston on the 787 with a low failure rate. But we don't know when they stop performing it and how much rework is involved. So we'll see how much of a hit it is. Spirit's reporting it's a $50 million loss for them in the second quarter because of this work, because Boeing's going to have to slow production on the 787 because of this. Boeing's also slowing production on the 787 because of heat exchangers using titanium from Russia, as well as some interior supplier delays. So we've seen now 3 issues pile up on the 787, and that's really what made us cut our delivery forecast from 90 to 60 units for the year. But, you know, this is a problem inside the Boeing factory. Charleston's actually a beautiful place to live, a beautiful factory. There's nothing that could be very nefarious in that site. So I think the new CEO has to come in and ask the workforce what it needs to perform tasks accurately, whether it's wages.
Okay, I'm sorry. Pause. Why are we not just doing some big whole-scale investigation, internal investigation? Why are they not hiring an outside firm to come in and basically do an unbiased, complete sweep of what could go wrong so that they can figure out how to change things?
There's been a host of committees after committee, you know, a safety committee, this leadership, that leadership. I think what we need to do is see what the workforce needs. You know, one of the things we've talked about is the workforce hasn't had a pay raise since 2014. 30% of the workforce, which is part of the IAM union, is set to negotiate in September or in the summertime with a September deadline. So we'll see if that brings any improvements in terms of the workforce getting a raise. We've seen a 30 to 40% raises across the airlines. So we could see something of a similar magnitude at Boeing. But also I think some of these processes need to be fixed. Maybe working with the FAA and saying this test doesn't make sense. It takes us very long. It's very physically arduous to perform. So can we remove it given it doesn't have a failure associated with it? So maybe some sort of more, I think rather than a law firm coming in or an audit committee coming in or a safety committee, it's just speaking to employees and seeing how tasks could be performed differently.
I go back to an earlier FAA report that talked about this disconnect from the shop floor, those workers, to the C-suite. Who's running that now? Who's trying to understand what is going on the shop floor and why that information doesn't seem to trickle up to management?
Boeing has heads of programs, whether it's the MAX or the 787. They also have a COO in place. So, you know, there are layers of management. I just think perhaps an overhaul of the system and how better manufacturing processes could be put in place. And we've seen that done. I go back time and time again to General Electric, where facilities used to be run differently, and with new management, Larry Culp has come in and changed the facility layouts to better perform for workers in the factory. So I think it's maybe a little bit of an overhaul, and that's why Spirit, I'm going to bring Spirit up today because they just reported a massive loss this morning. That's why Boeing's looking to double down and buy Spirit, not because I think that it could be easier to buy Spirit, but because Spirit will need that cash infusion, whether it's automation, a new facility, a facility overhaul, to perform better.
When automakers get into trouble, I'm thinking more recently of the Takata airbag scandal, if we can call it that, when you had to recall tens of millions of vehicles, kind of got an idea of how that works. How does a mass recall of airplanes, what does that look like if they had to do one?
We've seen them actually since 2020. We've seen it whether it's with the MAX or the 787. Let's not forget that 787 didn't deliver a single airplane for 2 years. It just restarted deliveries about 18 months ago. So it's had a whole host of issues, but it's producing at a lower volume, right? We're at 5 a month. The 737 is supposed to be at 38 a month, but we're really at 15 to 20 a month. So 787, and the facility is brand new in Charleston. And so it's a much cleaner, leaner facility to work at as well.
Sheila, this was awesome, as always. Sheila Coley there of Jefferies, as the allegations and investigations, Lisa, keep piling up over at Boeing.
I thought what Sheila said about wages was interesting. Basically, if you have people who had to go into the office or had to go into the plant during the pandemic, who got no raises, and they had to do all of these extra things that took a lot more work, well, why not cut some corners because no one's paying them anyway? How much is this really basically a quiet quitting issue, or sort of how do you get people enthusiastic again?
As some people suspect, based on yesterday, some corners have been cut. In fact, many corners. Equities right now on the S&P 500, positive here by 0.1%. The opening bell is about 34 minutes away. Coming up tomorrow, here's the lineup for you. Marvin Lowe of State Street, Christian Mamani of Lafayette College. We'll catch up with Mandy Zhu of SIBO, and we'll speak to Kathy Jones of Charles Schwab as this bond market, Lisa, keeps on rallying.
because people believe in the disinflation narrative. You hear Mark Zandi, he's saying this just finally gives us the excuse that we all are seeing, which is that inflation's coming down and the Fed will be able to cut.
He's not screaming, oi, the deficit.
Well, he actually says we should say oi the deficit a little bit.
Just every now and again.
Yeah, because
just not too much.
The oi is actually what makes it not a problem, because then people deal with it.
3 hours of sophisticated.
The TD Cash credit card gives you choices.
Thai. Tacos.
Earn the most cash back in the categories you choose, like dining. That's how credit can be unexpectedly human.
If you need to enable efficient brand management, then Paperfly is the platform to go for. Paperfly means that, of course, we can design and deliver great material on brand. It also means that our designers can spend time setting up or defining templates and then go off and start actually evolving our visual identity. Who doesn't like to save both money and time? You don't have to invest money in third-party producing things because you can do it yourself through the Paperfly platform.
Pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you...
I had actually run tech banking and took Google Public, so I had a little sneak preview.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
From New York City, from viewers worldwide, a very good morning. I'm Manus Cranny. So we're pausing for thought. We've got Kashkari later on in terms of the Fed speak, but it's not exactly a whole new world at Disney. The stock is lower. Bob Iger has a challenge to do. Subscribe more. Countdown to the Open kicks in right now. Coming up in the show, those futures, they lack conviction after a strong start to the week. Traders brace for more Fed speak with limited data on the docket. And shares, as I said, in Disney under pressure. The subscriptions miss the mark. We begin with the big issue, growing rate optimism.
As the data come in, hopefully we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy, and then we'll make our decisions based on that.
If they haven't cut in September, they're likely to cut in December. Again, there's still a question of, will inflation actually decelerate enough by then?
It is going to come down to that disinflation narrative. Mike McKee is with me. Mike, what did we learn yesterday and what are we set for today? We've got big auctions, but a mountain of Fed speak to get through before the end of the week.
Well, the auctions might end up being more important because they're today. There is a question about how much there's going to be take-up of the Treasury debt and at what price. But we do have a lot of Fed speak that probably isn't going to add much to the discussion because, as you heard, people have already made up their minds on the Open Market Committee that they're going to wait for a while. Here's what Tom Barkett from the Richmond Fed said yesterday. He's optimistic today's restrictive level of rates can take the edge off demand in order to bring inflation back to our target. The full impact of higher rates is yet to come. Now, that kind of explains where the Fed is at and why the markets don't necessarily like it. Take a look at this chart here. The Fed is looking at real rates. And as you can see, real rates are at levels that led to recessions in the past. The market is looking at the blue line below, which is financial conditions, which have loosened. And they think the Fed might be setting us up for additional inflation. So who's right? Well, there's going to be a lot of data between now and the June 12th Fed meeting, and that inflation data is going to be very key. So while we may not get something new out of the Fed speakers this week, we do have CPI next week. The Fed minutes, did anybody at the last meeting talk about raising rates? And then another PCI, another CPI before the Fed meeting. So they'll have plenty of data to look at and see if they have that confidence they're looking for to lower rates.
Well, that conversation on raising rates was something that Powell really did push back against. Mike, thank you very much. Mike McKee. Today, we have an interview. We will bring that to you with the Minneapolis Fed President, Neil Kashkari. That's coming from the Milken Conference at 1 p.m. on Bloomberg TV and radio. Let's continue the conversation. Quincy Crosby of LPL Financial and Ed Al-Husseini join me from Columbia Threadneedle. Gentlemen, good to see you both. 5 days that shifted the dial on 10-year, 2-year and 5-year paper. This is the 10-year government bond yield, down by 23 basis points in the space of 5 days. The bond market's faith in rate cuts has been restored. Has yours? Ed, good morning.
Hey, good morning. No, I think you're absolutely right. I think it was really a function of the Fed reminding us that the threshold for rate hikes remains relatively high, and that's something that was kind of seeping back into the market given the inflation data in Q1, and the Fed's effectively taken that off the table. That's been a really nice temporary ceiling, I think, on the longer part of the curve.
Okay, so that's a nice portion. Quincy, good morning to you. Here we are. You know, the equity market has taken flight. A number of reasons. You have earnings, but you have this repricing at the very short end of the curve and the faith in cuts, perhaps not fully restored, but reignited. What does it mean for you?
Well, one of the other aspects for the market is the liquidity that the Fed offered with the quantitative tightening program. That certainly helps the market, and it helps the market for a number of months, probably going through to the election. But overall, the earnings have come in better than expected. Obviously, the market is now waiting for the 22nd when we hear from NVIDIA. But overall, this is a market that needs something. If we're not going to have rate cuts, you've got to substitute something else. And that has to be an economic backdrop that is not hot, that's not cold, but just looking at a rebalancing of this economy and a cooling of the data. But overall, we have seen the market with the S&P 500 regaining its 50-day moving average. But one thing we have not seen is on the days that the market has been up, closing higher, the volume hasn't been there. It tells you that the market needs more confirmation for an endurable rally. If this rally can continue, it is going to probably lead us with a strong market through the summer because the historical patterns indicate that. So I think absolutely that where we land with the 10-year Treasury, where we land with the 30-year, with these auctions, it is going to be, we hope, a catalyst for this market to say, okay, this is what the auctions are telling us. Let us move ahead and offer more confirmation to the equity side of the market.
So, Ed, it's up to you and your tribe to deliver. 6-month T-bills were welcomed over 3 months as that rate cut narrative got wound up. We've got 42 billion in 10s. We've got 25 billion in 30s coming a little bit later. Now, as Quincy says, it's over to you. Prove to us that you can eat a bountiful meal and not get any indigestion. Is that how you see the 125 billion that we will have had by the close of business this week?
Yeah, look, I think demand for duration assets, long duration assets, whether they're coming from the Treasury side of the house or high quality investment grade debt, has been really well met this year. I don't really see significant issues in us being able to digest this supply. On the margin, the Fed's balance sheet is in the background. It provides a little bit of background music. I don't think it's all that important for taking down these auctions. I think the key issue here is the all-in yield, whether you're looking at the long end of the Treasury curve or, again, you're looking at it through a credit lens, the all-in yield is very attractive. And there's plenty of institutional investors who are still coming off the sidelines into this market. So I'm not really concerned at this stage that we'll see any kind of dislocations in these auctions.
So, Quincy, back to your point, which is, you need to see some kind of, as it were, confirmation of this Goldilocks-like scenario. I was looking at what Morgan Stanley have had to say, and Ed, you can chew on this, which is buy bonds because there will be a rapid deceleration in PCE without the economy tanking. So to your point, Quincy, this is really what we need to see. We need to see reasonable growth with reasonable profit margins and a dissipation in inflation. Is that enough to put a floor in equities and maybe even propel it higher?
Well, yeah, I mean, one of the things we're seeing from this earnings season is that profit margins have been strong. We always look for that because that is the key to whether or not they are going to have to turn around. These companies are going to have to turn around and let people go. The labor market, yes, it is holding up. It's solid. But there are questions as to how long this can continue, because after all, that is the pathway towards a recession if the consumer feels that there are no jobs and they start seeing major layoffs. So we go back to the earnings and we hear operating margins okay, profit margins okay. That is excellent for the tone of the equity market. What we want to see, though, is that the yields are not coming down so quickly because they are looking at a much weaker economy. When we look at utilities, utilities have very often been that guide that when rates are higher and utilities do well, it is the utilities market suggesting, we're reaching a top. We're going to start seeing the rates come down. But there's another element now for utilities. Is it also suggesting that, we're going to need to upgrade our grids? We're going to need more power for the data centers. So that's also entering into the conversation about what utilities typically tell us. But overall, what this market doesn't want is a escalator down or an elevator down quickly with those yields.
So Ed, with that in mind, just listening to what Quincy's saying is we don't want an escalator down in terms of what's going to cause yields to drop. And this goes back to what Morgan Stanley are saying. They said it is residual seasonality that will impact the slow drift lower in PCE, not the escalator down that Quincy is outlining that we don't want. Which one do you expect is the firmer narrative?
Yeah, look, I think there's a really good probability that inflation, the decline in inflation was a little bit exaggerated into the end of last year. It was perhaps a little bit exaggerated to the upside in Q1. And, underlying inflation is running at about 3%. We're likely to see some cooling off of those levels. The thing that I'll point out is if you look at where rates and risk markets are today, they've priced in very healthy growth, close to 2.5% consensus. They've priced in relatively lax financial conditions, and they've priced in a little bit of room for the Fed to cut, roughly 40 basis points. Let's call it 2 cuts this year. That's consistent with some of that inflation coming down. So that Goldilocks scenario is very much already in the price. And I think what worries me is with expectations being nailed to the ceiling, particularly around growth this year, it's going to get a lot easier to disappoint them to the downside. And I think we're starting to see early signs of that in the labor market. We're starting to see early signs of that in the growth story.
Well, we are. We certainly saw some cracks in the services industry. We've seen trading down, perhaps, at some of the broader retailers. Quincy, let me get your perspective. Disney has been sort of a couple of different stories this morning, but if I look at Disney, it is about subscriber growth disappointing relative to what the market wanted. The CEO's on the tape now talking about password sharing, cracking down on that. The stock is down by 8%, but when I look at the business, Parks growth is moderating from peak COVID levels. It's more about a normalization on the consumer side of the business in of itself. What did it say to you? What does Disney say to you about the health of the consumer?
Well, yeah, no, I was watching that very closely, but you still see the growth in terms of the parks. It was over in Asia. It was in Asia. Over in California, it was much slower. When we look at Florida, we know that the numbers are coming down. It's too expensive for the average American to even go with just one child.
Down, a little bit of consumer slowing down at Starbucks, a little bit of consumer slowing down at other retailers. Ed, to what extent are you and the bond team buying into the hypothesis or believe in the hypothesis that immigration, as Adam Posen said to me, if you're not a border politician, immigration is good. It contains the wages spiral. Is that part of the alpha for bonds going forward?
I mean, immigration's been a really interesting story. It's definitely played a big role in adding to the supply side of the labor market. The extent to which it's impacted wages is probably relatively small in my mind.
Okay.
Last year we were talking about 3.5 million people missing as a result of lower participation post-COVID and missing migrants. Now perhaps we're about 2 million people above trend. So there's been a swing of about 5 million workers. Our labor force is 160 million people. So the extent to which that 5 million makes an impact on wages is not huge, but it's important. It's good towards balancing out the number of vacancies and so on that we have in the labor market, and it reduces the churn in the labor market, which is something the Fed's been looking for. Does it impact wages? I would say not really.
Okay. Well, maybe it is that we need to redefine what scale of immigration, what type of immigration contains wages in various component parts of the economy, rather than that sort of umbrella statement about immigration. Ed, thank you very much. Quincy Crosby and Ed Al-Husseini on the markets this morning. Let's look under the hood. Ahead of the opening bell, Abigail Doolittle is with me. Abby, what have we got?
Well, despite the fact that we do have the U.S. equity futures slightly higher, we have a couple of notable laggards to take a look at, including Disney. Shares heading to the worst day in about a year, down 7.5% for the reasons that you all were just talking about. Streaming subscribers coming in short of the estimate, a lagging growth in parks ahead. They did raise the revenue guide, but it was slightly short of the street. And into today, up 29% over the last year, so investors wanted more. Palantir down 12.4%. The data company boosted its forecast, but not enough for a stock, if you can believe it, up 226% over the last year into today. Price to perfection, you could say. But take a look at Peloton, up 20%. CNBC reporting that a number of private equity firms are circling, considering buying the fitness company, Manus.
Okay, Abby, thank you very much. Keeping an eye on those stocks as they move. Coming up, Disney beats profit estimates.
We're obviously very judicious with the way that we price. We want to provide access to as many guests as we possibly can. But we do believe that the great experiences we provide, people are willing to pay for.
Strong earnings report overshadowed by that miss at Disney Plus on the subscriber side. All in conversation.
You may get a little excited when you shop at Burlington.
of commercialization.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Tentative bid in these stocks. We're really trying to sort of find our footing. I don't know whether we can bloom for as long and last as long as flowers.com, but right now this market is up. We're going to get a little bit more Fed speak later on in the day. Yields are lower, and that is what's driving the breadth story today, up by 0.2% on the Russell 2000. This is how the rest of the market looks. You've got the euro dollar trading a little bit higher. The German factory orders actually were a little bit lighter on their feet. Demand falls in February, so that's from February, I should say. So those numbers a little bit lighter in Europe. 10-year yields down 4 basis points today. I can tell you in the past 5 days, there has been a continual momentum down in yield on the bond market, down by over 20 basis points at one juncture. Crude is down by 0.25%. So that's the state of play across the assets. One stock to watch, we've touched on it a few times, it is Disney. The shares are under pressure, posting fewer than estimated subscribers on the Disney Plus streaming service. We've already had a conversation, Abby, haven't we, where it seems to be about the parks business also under pressure.
Yeah, that's exactly it, because that parks business really the reliable cash cow, and now there's some concern that growth for the current quarter, because it's basically flat, investors concerned, worried that maybe there's going to be some sort of an issue there. Relative to the stock, you can see that it's really plunging down 8.5%. Its worst day since last year. At the lows, though, this morning, just moments ago, down 9.3%, the worst day since November of 2022. So investors really concerned again, despite the fact that they did beat profits, there was a small revenue miss. When you put it all together, they raised the fiscal year profit view from 20% growth to 25% growth. The street looking for 25.5%, so a small miss there. To your point again on parks, the growth is expected to moderate. The small subscriber miss for a stock that was up 29% this year into this report. Over the last 3 days into the earnings report, Manus up 5%, really suggesting that investors were looking for just a clean quarter and guide across the board. They didn't receive that. This stock now, again, down 8% on the morning. Yeah, pretty brutal. Abby, thank you very much. Let's turn our attention to the software market. Palantir falling after investors were unimpressed, to say the least, by the company's outlook for its annual sales. The stock has tripled this year into the numbers. That's some context for us, Alex, isn't it?
It is, Manus. Well, unimpressed is definitely an understatement when it comes to this report. The company actually did deliver on earnings, but it didn't deliver on guidance. That likely explains the downswing that we're seeing this morning. Shares down about 11%. That's the worst since November 2022. And the company, co-founded by Peter Thiel, is one of the emblems of the AI frenzy that's helped shares surge more than 200% in the past 12 months and about 15% in the 4 trading sessions leading up to the results. But investors were unimpressed by the outlook for annual sales. It nudged up its annual revenue forecast slightly higher to a range of $2.68 billion to $2.69 billion. That is roughly in line with Wall Street forecasts. This reaction, Manus, is a testament to how high the stakes are for companies to deliver on their AI promises. And it's not just about what companies have shown so far, but what they see for the future. And it's really been a theme this quarter. More than 80% of companies have beat earnings this quarter, but we're getting the worst same-day earnings reaction since the end of 2020, and that is attributed to these disappointing outlooks. William Blair says that Palantir is down because of the sharp deceleration in U.S. commercial revenue growth. That's a focus for investors because of the AI push, Manus.
Okay, well, certainly a double-digit loss on the ticker at the moment. Alex, thank you very much. Turn over to EVs now. Lucid revealing wider than expected losses to the start of the year. This is as the company contends with production challenges and an uneven roadmap for demand. Katie, just put the two together. This is a bit of a slap down by over 9% at the open.
Yeah, and you really are seeing that pain reflected in the shares, like you said. Let's get into some of the numbers here, because Lucid, it posted an adjusted loss of about 30 cents per share in the first quarter. Analysts had been expecting a loss of 25 cents a share, so clearly a bigger loss than expected. Revenue of about 173 million, that was above expectations. Clearly, that is not the focus this morning. And like you said, Lucid really trying to overcome production hurdles and at the same time sagging consumer demand for EVs. It recently secured about a $1 billion cash injection from a Saudi investor. So maybe that will continue to or start to bear fruit, because Lucid said that it still expects to make about 9,000 vehicles this year. That is reaffirming their earlier forecast. But you take a look at what Bloomberg Intelligence has to say, and their view is that Lucid's Air sedan could, quote, keep dragging on profits, while production increases planned for this year could hurt margins in the second half. You add it all together, shares down about 8% almost at the moment, lower by about 33% in 2024. Just to give you some context, Manis, that is even more than Tesla's year-to-date loss.
Okay, Katie, thank you very much. Katie Greifeld there. Turning to tech. Apple has been developing a homegrown chip to run AI tools in the data centers. That's according to the Wall Street Journal. Alex Webb is with me now. I mean, they're all trying to come up with a solution where they may not be so inextricably linked to NVIDIA. I'm talking about a lot of these players in the Mag 7. But talk me through what Apple are doing and whether it will come to fruition according to the story.
Yeah, so the Wall Street Journal is reporting that they are working on this product. We don't yet quite know what stage of development it is, whether it actually will ultimately be produced, but it is something, these chips geared towards AI, presumably accelerators. Every big tech company is working on them right now, and Microsoft, Google, Meta, and Amazon even. Now, part of that one suspects is that, yes, it will help them build chipsets that are finely tuned to their needs, their precise needs, what they want to do. But also, NVIDIA right now, which is really the only game in town, has a huge amount of pricing power. What we've seen over the past 12 months with the huge acceleration in NVIDIA shares is not just that they're selling more chips, but they are selling the chips they can for more money. And so if you are an Apple, you're probably going to be looking for a little bit of pricing power.
Okay, Alex, thank you very much, tracking the Apple chip story. Our next guest, pretty much ahead of the pack, making Apple his top pick. That was late April, and he wrote this, that the company has a rich capitalist path with defensive cash flows, to say the least. Wamsi Mohan joins me now, senior IT hardware analyst over at BofA Securities. Your price target is $230. What goes through my mind as they announced the biggest buyback in the history of American equity? Are they on defense or offense on the payouts and buybacks? Wamsi, good morning.
Good morning. Thanks for having me. Yeah, I think this is sort of par for the course is the way I would phrase it, right? Like, if you think about what Apple has been doing, they've been very consistent and opportunistic in their buybacks. Over time, their buyback program has been extremely successful. And it helps, of course, as the stock is up to the right. But when you look at sort of the magnitude of what we're talking about, the 110 billion, right, and Wall Street was largely expecting, we were expecting 90 billion, it just shows the confidence in the cash flows. And this is what we meant by saying there is a defensive moat around the story in terms of continued earnings power and continued cash generation, such that they can keep this level and pace of buybacks, which are, just astounding, ongoing. And that confidence in cash flows is really coming because they do have this potential to really tap into a lot of markets that are not on people's horizons today, right? When you think about healthcare market, for instance, or you think about the advertising market, there are just these huge TAM opportunities that are ahead of Apple still, and everyone's very fixated on the quarterly numbers of the iPhone. I think it's time to step back and really take assessment of what are the long-term opportunities for growth, and those are some really huge potential TAMs. Okay. And we just, your prior guest was talking about the AI server chip market. That's another potential large market, right? So there are a lot of untapped markets for cash flows.
Well, what goes through my mind is, of course, are they the good guardians of capital? In other words, returning it in the form of share buyback relative to perhaps the perception is in other Mag 7 stocks that you're squandering it on moonshot ideas. So this is about governance and I would say prudence over capital. when it comes to innovation, Apple, I mean, they create products that we never knew that we ever wanted or needed. We've gone into the Gobi Desert, as it were, of innovation. We're in the desert at the moment. So where do you think their biggest bets will be on the innovation that we don't quite know that we needed yet? You've mentioned health and you've mentioned chips. As you look towards these big reveals later in the year, where do you think the biggest reveal could come?
Yeah, I would sort of look at innovation a little bit differently, right? And yes, I mean, an iPhone 15 versus iPhone 14, incremental for sure, right? But at the same time, when you look at an iPhone 11 versus iPhone 15, that's the order of magnitude improvement in camera quality, in microphone and speakers, in audio and spatial audio. So innovation is well and alive. It's not completely obvious on the surface of it. We think that a lot of the innovation actually is beneath the surface, right? And when you think about that, that's really, it comes down to their silicon innovation. And they've been designing more and more and more chips that are tailored to their needs, whether it be for spatial video, whether it's all the new chips they put in the Vision Pro, right? So there's this silicon innovation, and that takes time. It takes consistency. It takes 4 or 5 year cycles. So what we're talking about at Apple really is a vision into the future where they're currently working on projects that are 5 or 10 years out. That is the level of cadence you need for a company that's churning out, 200, 300, 250 million iPhones a year, right? So when you think about the next step really around innovation, what we think is that generative AI is going to be a huge catalyst. And why is that? It's because, not only do they have leading edge technology in silicon, they're going to embed more and more of that compute density locally. They have the best data on the planet about anyone sitting on device. So it fits Tim Cook's perspective on privacy, where nothing has to leave the device, but at the same time, you're able to really monetize that at 2 levels. One, from giving you a very good hardware experience on device, and secondarily, by enabling developers to really tap into this hardware and then monetizing it at the services layer. So we think this is a multi-step opportunity for in generative AI that's going to be a huge next catalyst for Apple.
Okay, well, I mean, we have the big reveal on the iPad. I don't think that's going to be the transformative moment in sales and volume, but it will be a mini curtain raiser. Can I just square off China? Many people come in here and they go, Wedbush Securities being one of them, Dan Ives going, he's an evangelist, he's a sinophile, the worst is past, and there will be better times ahead. You would also concur and say that the China woes are unfounded. But I would put it to you, we've got the same set of risks in China. The risk parameters in China have not changed. So what gives you the confidence to say that China, the concerns are unfounded?
So I think that we have to put the China concerns in context, right? When you look at China, it is still a ginormous market from a demand opportunity standpoint. You still have a lot of the middle class that is coming up in tier 2, 3, 4 cities where the amount of spending power is increasing. And if you think about Apple, Apple actually grew units in mainland China. Not in Greater China, but they did in mainland China. And that is despite facing some tougher compares from a year ago and 3 points of currency headwind. So when you dissect all the numbers, the iPhone franchise in China is alive and kicking. Has Huawei taken some share recently? Yes. I mean, Apple has had free reign of the China market for 4 years when the U.S. put restrictions, and clearly Apple capitalized on that. Is there going to be some period of give back? Yes, there can be some period of give back. Does it mean that this is structural? No, we don't think that means it's structural. Apple will continue to innovate. We're not seeing a mix down even in China. Yes, there was some promotional activity, and every company does that at cyclical times of need, and so did they. And so when we put this into context, we think that longer term, this is a big opportunity, continues to be a big opportunity for Apple. We think that, again, like when you have a device that is capable of doing things truly to improve productivity, like the iPhone can when generative AI features are embedded in it, we do think that the China market and China consumers will embrace that. Form factor change has not been something that has happened recently. China consumers love that. We think Apple's going to do a foldable over the next several years, and that's going to drive increased interest in an upgrade cycle too. So it's just that I think people tend to look at it from a very static standpoint, whereas Apple is innovating behind the scenes and coming up with interesting technologies that will capture the fascination, we think, of Chinese consumers apart from the global consumer base.
Okay, well, you made the call, Wamsi, and the stock certainly has responded.